Stablecoins got a bad rap at the beginning of the so-called crypto winter.
Bitcoin down 13% today.
Wow, look at crypto. It got crushed.
Is what's happening with Terra USD, how is it not a black eye for the entire industry?
It's one of the worst scandals in the history of the crypto industry.
That was a certain kind of stablecoin, though. Terra, as we explained just a few times before, was an algorithmic stablecoin. Stablecoins like Tether and Circle, those are fiat-backed stablecoins. That means that somewhere in the non-crypto world, there's supposed to be a reserve of fiat currencies or cash-like financial assets that help the digital tokens remain pegged to the US dollar on a one-to-one basis. Fiat-backed stablecoins have largely been able to weather the storm that caused Terra and Luna to collapse.
All stablecoins, regardless of how they try to achieve stability, need to have the trust of their users to remain viable and stable. And the one way you achieve that trust is when someone shows up and says, I want to redeem my stablecoin for a backing asset, that process works. During the recent sell-off, all stablecoins, all fiat-backed stablecoins, but particularly Tether, were able to meet a significant amount of redemptions, billions of dollars worth, without a hitch.
The top fiat-backed stablecoins are Tether and Circle.
Circle's USDC coin has been gaining ground on Tether in recent months, closing in on its $68.5 billion market cap.
By trading volume, however, Tether remains far and away the most popular stablecoin. Circle and Tether have much different approaches when it comes to clarity around their reserves. Tether has been criticized for not being transparent enough about its reserves. Still, Tether remains popular among traders looking to quickly get in and out of their crypto positions, using Tether like a money market account in between trades. Circle, on the other hand, has gone out of its way to prove its transparency. It's been releasing monthly attestations from accounting firm Grant Thornton to provide assurances about its reserves. That's making it the stablecoin of choice for non-crypto companies looking for a payments partner.
If Circle continues to execute on the general plan to become the most regulated and trustworthy, or one of the most regulated and trustworthy stablecoin issuers, then I do think demand for its coin will grow, particularly as institutions continue to enter crypto, because as a rule, institutional users only want to deal with regulated counterparties. So many of them are going to stay away from Tether no matter what. And there's a lot of institutions out there with a lot of capital that could potentially adopt something like a USDC. But that doesn't mean that Tether is necessarily going to go away, in part because part of the appeal of Tether to a small subset of users is their regulatory light approach.
In response to concerns over its reserves, Circle this week released a detailed breakdown of its holdings, about $55.7 billion in total, with $13.6 billion in cash and $42.1 billion in short-term U.S. government bonds.
The dollars are held in cash and in 3-month U.S. government treasury bonds. So it's a very, very kind of different structure. It's regulated, it's liquid. And that's really where that flight to quality has been, as people have taken risk off, or they've removed, liquidity from, stable coins that they perceive to be much higher risk.
Circle's reserve wasn't always so liquid. In August 2021, a Bloomberg report disclosed that Circle's partner Coinbase was falsely claiming that each USDC token was backed up by one real dollar. Back then, Circle's reserve had riskier assets like corporate bonds and commercial paper on its books, so the one-to-one cash claim wasn't entirely true. Tether has also released attestations from third-party accounting firms, but not as frequently as Circle, and its reserves hold a mix of securities, including other digital tokens, secured loans, precious metals, and corporate bonds.
You mentioned stablecoin. I did not bring that up, but there is one that is regarded as being perhaps not as transparent as we'd like, which is called Tether. And it's very big, about 60 billion. If they told us what they were really in, what they had their money in, wouldn't that be better for everybody?
Look, transparency is a key part of the investing formula. It's kind of part of the basic bargain that you get to, on a quarterly basis, know something about the companies, and if material events happen, like they do all the time, and companies make additional filings called 8K filings, and the public gets to decide what risks they want to take. That's the basic bargain.
Tether has also gotten into hot water with regulators. In February 2021, the New York State Attorney General announced an $18.5 million settlement with Tether and Bitfinex, which are both owned by the company. The New York AG said that it found at certain times Tether had no reserves to back the token's dollar peg.
The most important thing when you are running a stablecoin and you want it to be tethered to the underlying national currency, that in this case is the dollar, is having instruments in your portfolio that track the underlying currency. And of course, you have to have the right type of reserves. As we have seen with US Treasuries, we were able to fulfill around $7 billion in redemptions in 48 hours, 10 billion in 1 week, and around 20 billion in 1 month.
The makeup of these reserves is super important because fiat-backed stablecoins need their reserves to be as liquid as possible in order to allow as many investors as possible to redeem the tokens on a one-to-one basis, even in a worst-case scenario, like all of the investors attempting to cash out at once, similar to an old-fashioned bank run. Now, it takes time to sell securities like corporate bonds or precious metals and even short-term debt. That is the central criticism now facing Circle, that even after posing as the self-regulated, responsible, fiat-backed stablecoin compared to Tether, it too deserves more scrutiny over how well capitalized its reserves are. So if crypto winter has proven anything, it's that nothing is stable for too long in the wild west of digital assets. Crypto remains in the throes of an ongoing liquidity crisis. Stablecoins have always attempted to provide a lifeline of liquidity within the crypto ecosystem during good times and times like these. If any cracks begin to emerge in the market's two largest stablecoins, Tether and Circle, then the so-called crypto winter may have only just begun.